The highlight of the day is about to start, and the first point is the keynote by Dr. Andrew Henderson from Eversheds about regulating crypto tokens, the case for clarity.
To add restrictions.
And then Andrew himself will join the panel, moderated by Nicholas, by Data Dash, with Vic from Nivara, Piers from Radix DLT, and our own Michael Messele, with a broad topic, ICOs and ICO investing. Let's see what will happen. Andrew, the microphone is yours.
I hope you can all hear me, but not hear me too loudly. I always get told off because I have this booming voice, and I have to moderate it down. I'll try not to get too excited. It's difficult, many would say, to get that excited about the regulation of cryptocurrency, and particularly at around about, is it 4 o'clock in the afternoon? So first of all, I'm very grateful that you've all actually showed up. So I know there's some interesting people to come. But really what I'm hoping to do is just to set the scene somewhat. There's a lot of talk about the regulation of ICOs, and people say, is it a utility, is it a security, blah, blah, blah. And what I'm hoping to do is really just to try and explain why this discussion is important in setting the scene, and also just to share a bit with some of the classification systems that we've been looking at and been thinking about. So what I'm going to seek to do, first of all, just explain why regulation actually matters, because a lot of people say, what does it mean to regulate? It has a lot of different meanings. And then the next thing really is to talk about a method for classifying tokens, which would be the subject of an initial offering. And it's a tripartite classification that we've worked on, which we say is important. Once you understand the idea that it is a token's function rather than its form that should determine how to be treated, that then helps really move the conversation forward. And then in keeping with the focus really on ICOs, I'm going to say a bit more about this concept of the crypto voucher. And again, that's just the term we've used. Some people talk about crypto certificate, a crypto asset. But really this helps begin to unpack what we say are being offered or put forward when we talk about an ICO. And perhaps we should really start talking about ITOs, because it's an initial token offering, and to unpack some of the differences between an asset-backed versus an asset-based versus an asset as a token. And then finally, to say something about really the blockchain as an equity exchange. And many would say, well, that seems quite revolutionary. We say it is. And certainly when someone first came to me explaining blockchain, explaining its applications, one of the things that struck me was its real-life application in the world of the trading of shares and bonds, and particularly the manner in which those things are policed and controlled. And one might say, we don't want to talk about policing and control, but if you look at what you see in the press, if you look at what regulators are doing, the concern they have for investor protection, it's inevitable that this is an area that is going to be subject to more governmental control. And the key thing is to be in a position whereby one can guide that dialogue, and the essence of a regulation ensure that the rules that are imposed are the right rules, that they are fit for purpose and that there are not too many of them. So hopefully that sets a bit of the scene. And really what I want to turn and start with, people talk about regulation. This thing's regulated. And you have to be regulated to do this. That's unregulated. It's a regulated security. It's an unregulated utility. What does that mean and why does it matter? And we say really that there are 3 issues that one needs to bear in mind. For want of a better term, the first issue, the pun falls on the issuers of tokens. And it really goes to the question around disclosure and the question around whether it is necessary to have a piece of paper, a brochure. Some will call it a prospectus, sometimes call it PPM. Some would even say that is what we think of when we talk about a white paper, but understand that that concept can have many different applications. But is there a set of rules in place which prescribes what I have to say in that paper, and also says that I have to get a governmental authority such as the SEC or the FCA to bless that and approve that? And that is important because there's a lot of work that will go into the preparation of it. But that is one form of regulation. We dare say the securities regulation. And that is the form of regulation that is attached or attracted the most interest. But there are others. The second is what I would refer to as the broker-dealer regulation. The fact is that in addition to the people issuing tokens, there will be others that are carrying on activities. They might be marketing them. They might be looking to trade them, doing the stuff that broker-dealers do. And they are also subject to a form of regulation. And so that initial manner in which that token is treated also becomes important for that question. What does that mean in practice? It means that they're likely to have to go and get a license, that they're going to have to comply with certain conduct requirements, issues around trading, marketing, etc. But that is also the third point. And then the final aspect really deals with the exchanges, those that provide the infrastructure for the buying and selling of tokens, and the question of whether they have to be regulated trading venues, whether they have to be treated like securities exchanges. Do they have to have special sets of rules, special sets of admission criteria, processes for marketing, at least rather detecting and monitoring market abuse? So really, if we look at those three types of regulation, it's what we mean when we talk about regulation. But one point that I must stress, and that is that many will say, well, it's unregulated, so we can do what we like. That is wrong. When we talk about regulation, we talk about a special set of rules. The general laws will still apply. Simply because you are marketing a token that is unregulated doesn't mean that you can tell lies in a white paper, that you can seek to defraud investors. Criminal sanctions may apply. The general rules will always apply. And I think this is important because it comes down to the standards of disclosure that you'll still need to see in documents. But hopefully that just sets a bit of the scene as to what we mean by regulation and why it is important. And this then brings us onto this question of the naming of things. Now, we talk about tokens, and I think that is a term that seems to be gaining universal use. And indeed, the work that we're doing with the likes of 2030, we talk about the issuance of tokens. We talk about equity tokens. Some would say we talk about coins, currencies, et cetera, but actually the token becomes a useful, neutral kind of word. And it also means that we can take the token and we add onto this the idea of being a crypto token, and all of you will know a lot more about the cryptography aspects of it. But that is an important aspect that people forget about, I think sometimes. Words are everything. But the idea that the token has been subject to a special process involving cryptography and one might dare say privacy and the like, which also brings in a number of issues. But it also highlights a vitally important aspect, we say, and that is around the operational integrity. And I'm going to say a bit about this in due course, about how a lot of the risk in the financial system will start increasingly shifting towards operational risk and the importance of operations, the importance of chief technical officers and operations officers, even conventional financial institutions. But that bit really underpins and is almost taken as a given when it comes to the tokens. So when we now talk about the classification, why is this important? Because the classification of the token should determine the types of rules that it is subject to, the types of treatment that it will have. And this is where it becomes important to try and unpack whether something ought to be regulated or not, and how it ought to be regulated. Now, people will use names, and they will talk about a security or commodity or utility. We say it's not the names. Rather, it's the function that the token will fulfill. One of my colleagues and his brother, who is currently doing a PhD, and I, we did a journal article early in the year, and that article has been developed and published in an academic journal more recently. But essentially here we came up with a method. We called it the BBH method. The two brothers are called the Bernie brothers, and I'm the H at the end. But essentially saying, let's look at the general function the tokens fulfill. And the work that was done mainly by Andrew Bernie, who's the researcher, was empirical. He looked back at a number of offerings and said, what do these things actually do? What did they do? And from this, we came up with three essential categories. The first is the idea of the crypto transaction. What do we mean by that? Essentially, this is something that is a cash substitute. One might well say that Bitcoin is the archetypical crypto transaction. But here you are using tokens to buy and sell stuff. And it may well be a broad category of stuff as opposed to something that is more limited, which I'll also come on to talk about. The second idea was really that of what we describe as a crypto fuel. And this is essentially the tokens that underpin or power generic blockchain applications. And again, one that's often overlooked and very much sometimes will be the building block of the other types of crypto tokens. The question about whether those ought to be regulated in and of themselves will often be answered by reference to the question of what do they support. And then the final type of token, I think for the purposes of this discussion, we say the most important one, is that of the crypto voucher. And the idea of the crypto voucher is that it can be exchanged for a predefined asset. I was having an interesting conversation before, because I was in the discussion, it was suggested actually there may be a fourth category. And I think this is something one will need to think through. And indeed, as we unpack the crypto voucher concept, we really come to look at three basic types. The first is one that we would refer to as being asset-backed. And one needs to be slightly careful in terms of how one uses the terminology. I got into discussion with somebody who said that surely the idea of an asset-backed token is a separate category. And we said, no, we think you can accommodate it within this category of the voucher. But the idea was that that you still get an entitlement to a thing. Let us say it is a sum of money. But that sum of money is backed, it is secured by an asset. And it simply means that if the sum of money is incomplete or there's enough to pay you out, you can then look to the assets. The key thing we say is that doesn't give you an entitlement on the asset itself directly, but rather that's almost used as security. You're still essentially taking a credit risk on the issuer of the token. And this idea of risk, we say, becomes very important. Because when you start looking at the risk that you're going to be exposed to, and this is in very, very broad terms, you ask yourself the question about, am I taking the risk that if somebody fails or goes insolvent, I'm not going to be paid out? Typical credit risk. The type of risk you would take that on somebody that's issuing a bond or a debt instrument. And there are going to be vouchers that will be bonds or bond-like. Indeed, those have already been issued. And the question then is that how secure is that? And that's where you get into the question of it being asset-backed. The third is to really talk about it being asset-based. And interestingly, a lot of these categories are categories that I developed. I used to do or be involved in Sharia-based financing. And these concepts became very important, and they were quite subtle ones. But the idea that you shouldn't be taking a risk that generates interest means that you've got to derive a return by reference to something. And there's a distinction between that, because you're not actually having a claim in that thing, but merely the amount of money you're going to get depends on the flow from that. That we say is more asset-based. Some might say almost a form of derivative. But sometimes, again, when you're looking at the risk profile of the token, what it gives you, you're asking what are the risks. There's a credit risk. And then the third type of risk, which will really tie in then to the third type of token, is that of market risk. And this is really where we start getting into the crux of things. The market risk typically is the risk on the rise and fall in value according to supply and demand, the economists will tell us, of something. And here we just simply say that the token is an asset. It's something that gives you a direct claim on the asset. For example, the shares of a company. And that's really, in a sense, the holy grail that what one starts to grasp for. Now, the focus on the different types of risk becomes important because that will also have an indication on then how the regulators seek to police these. Now, it's clear we say that when you talk about crypto vouchers and financial assets, you are talking about tokens that have the characteristics of financial instruments such as shares, such as bonds, such as receipts, possibly even such as warrants and derivatives. And the form of regulation of those becomes fairly clear that it can be justifiably that is imposed by securities laws. One of the challenges you have is that if somebody simply says we're going to designate all tokens, all coins as securities, is that you get inappropriate regulation, rules being applied that just don't fit when you actually look at the way that they come out. And really the final point is, where does this then bring us? And I would say this is where the excitement comes. And I should say that I had a set of slides that I had forwarded. We may do the talk again. This time you can see the slides. The great thing about not having slides is people are forced to listen to you or ignore you, as the case may be. But the slides probably explain this final aspect. But it's the idea that if we find a way that these tokens can be treated as genuine financial instruments, substitutes, dare I say, for shares, for bonds, for the like, you then create a trading environment, which is essentially the blockchain. And this is where it becomes exciting. Some might well say that actually the classification system can fall down slightly. If we're going to use tokens on a blockchain to purchase other tokens which are genuinely financial instrument or security based, or are securities, call it you will, are those cryptocurrencies? What we call the crypto transaction vouchers, or actually are they themselves crypto vouchers that just give a right to exchange for cash, because that cash has a very particular purpose, which is just to buy and sell. I don't have the absolute answer to that. I think the models that we see will probably say they have more the characteristic of a crypto voucher because they're used for a very particular thing. But if somebody said, actually, we want to extend out the trading environment, we may want to bring those in. But by having the more controlled environment, which simply says that we can take someone who requires capital, let's say a trading company, and we can put them together with those who supply capital, possibly an investment fund. We take their cash, we take their shares, and we convert them into these tokens that can be exchanged, bartered, dare I say, on the blockchain, in this new environment that essentially relies on other people looking in to validate it. What does this achieve? Well, first of all, we say, and from what we see from our clients, from others, a saving of cost. Saving of cost will become very important in an environment where there is a pensions crisis, in an environment where people are worried about how we pay to finance our old age, and where there are ways of transacting that are expensive, or more importantly, could be a lot cheaper. And that becomes a very important policy imperative, because if you can put that to lawmakers, they will say that is very compelling. Because if we can save a couple of cents on the dollar, or a couple of fractions of a cent, or a couple of fractions of a cent on the euro, a couple of pennies on the pound, that is money that can be reinvested. And that becomes very, very important. But the other point as well, and one might say that this is the typical statement that you would hear uttered by someone who does regulation, is that this becomes an environment that becomes that much easier and cheaper to monitor, to police, market surveillance. One of the banes of my investment banking clients, my fund management clients, is the fact that they have to make reports to regulatory authorities under something called MiFID II, curse the day. And what this new type of trading environment actually creates and allows a situation whereby you don't have to go to the regulator to report to them, but rather you bring the regulator to the trading environment. And that certainly is we see as being one of the more exciting ways that this will, in the end, be policed and appropriate rules developed. Because if one can bring with this a reduction in the types of rules that are fit for purpose, proportionate regulation, then this all works a lot better. Now, hopefully that sets a bit of a scene for what I think is going to be a far more interesting conversation. As I say, I'd be very happy to give this talk with the benefit of the slides, and also to hear comments and what have you. The system is not perfect. And as I say, there'll be other ways of classifying things, to make those things. But at least we can start with a way of just saying to those making laws, don't look at what the thing's called, look at what it does, and then make the appropriate rules. And having made those appropriate rules, we can create these very new and exciting trading environments that are cheaper and safer for all of us. That's all I have to say. I think we're going to have the conversation.
Thank you very much, Andrew, for that keynote and for the start of the discussion. This is the starting point of the discussion. Our panelists are going up to the stage, and now we're going to hear more about ICOs and ICO investing. So, as broad as it can get, this is the topic that we have here.
Oh, yeah.
Prepare your questions. There will be a time to ask our experts on that. And now the microphone goes to Nicholas, who is moderating this discussion. Whenever you're ready, gentlemen.
Yeah, sure.
All right, here we begin. Awesome. Alrighty, everyone. Welcome to the panel. This is going to be a pretty exciting topic. I think we had a great opening speech on it. I definitely want to reflect on a few points that he had made, and also go towards introducing everyone. So we've got some pretty good people from a wide range of projects in the regulatory space and investment banking, so it's going to be an interesting panel. Just to start off, my name is Nicholas Merten. I am the founder of DataDash, YouTube channel in the cryptocurrency space, but nowhere near as exciting as all the individuals on this panel. We have Vic over here. He is the co-founder of Nivara. It is an issuance platform that's based, if I'm correct, out of London. They have some really revolutionary stuff coming in the pipeline. Along with that as well, we have Michael Messele, who is the co-founder of Pillar at the end of the table over here. And then along with that as well, we have Andrew Henderson, who is obviously just spoke to you just a moment ago from Eversheds Sutherland, working more in the legal framework of things. And we also have the CEO of Radix, which was not an ICO, very good to hear, known as Piers Ridyard. Is that right?
That's right, yeah.
So, like I said, we've got a really exciting panel, and I want to dive into a wide range of topics here and just kind of let the conversation go. That's how I usually like to do panels and moderate things. So I want to start off first, bringing back to a point you were talking about in the speech. One thing that I really liked towards the end, it made me reflect on something. I remember a few weeks ago, there was talks that from the SEC chairman and everything stating that he's like, all ICOs and RIs are securities. And I think that this is the stigma that's been brought about in the space because you see this disconnect in a sense. We aren't bringing the regulators into the space in a sense and trying to build a framework on what these tokens actually do. So I really appreciate that. And I want to ask you, do you see this space taking more of a positive tone over the past few months rather than where it was maybe, say, beforehand? Are you seeing more of a positive tone?
I think we've got to be very clear about what we mean by positive.
Yeah, it's very subjective.
But I think people become more informed. First of all, the lawmakers, the regulators, I think, are willing to listen more and to learn, and then to make policy and rules, I think, that are sensible, and also to do things that are more sensible. So I think that will be positive. Look, the reality is that the state does start intervening more, but the key thing is that with more understanding, with more communication, I think you can get better outcomes. And I think in that perspective, at least that discussion has begun, so that is positive.
So is there any kind of work in any kind of financial regulators to start building that framework in any specific governments that you know of? Because, it is different. You have the SEC, you have financial regulators in the UK and throughout Europe and Asia.
Yeah, there's an interesting phenomenon, and I know Vic will talk to this, and that is that what has been interesting in this area is the fact that regulators have been using their traditional role of developing rules and policing, but they're also trying now to create projects for innovation. Project Innovate in the United Kingdom, I think, has already produced or spawned a lot of imitations, and actually see the authorities now saying we want to create special environments for people, amongst not just in the crypto assets space, to come in to educate us. And then we can start making better rules. At the moment, there is a reluctance. A lot of discussion papers have gone out. What a lot will simply say is, look, the current framework should be able to accommodate those. But I think we would say that actually, the more you get into the detail, the more you get into questions around, taxation treatment, special rules, how do you avoid a crypto asset or the offering necessarily being classified as some type of mutual fund, you start needing to develop more nuanced carve-outs, and I think that will come, hopefully.
Starts to become more detailed, yeah. So I want to ask, spend some time to talk to Piers actually specifically because, Radix, I had heard about the project beforehand and a lot of people are excited about it, but I want to ask you, as someone who didn't conduct an ICO, what does it feel like, even if you're not going through the route of ICOs and everything, what's the regulatory framework for yourself and your project, even though you're avoiding a lot of the legal hassle in that sense?
Yeah, that's a really good question. So, I mean, we're trying to do a lot of things that are kind of regulatorily confusing anyway. One of the things that's sort of built into the fundamental protocol of Radix is a decentralized exchange with a decentralized order matching engine. And if that's built at protocol level, then who's the responsible party for the exchange itself? Like, the Radix Foundation doesn't receive any benefit from the exchange. The benefit comes from the fact that it makes every single token that is on it more liquid. And as a result of that, the total value of the network increases. But is that then a benefit from the transaction of securities or something like that, or is it something else? And then there's other things that we're trying to do. We think that low volatility is incredibly important in the unit that you use to transact across the network in terms of how you pay to use the network, right? So if you've got Ethereum and you've got gas, it's very difficult to make a long-range business decision on the basis of the gas price. So we looked at that and said, look, well, actually, if you want real businesses making real business decisions and being able to calculate margins and being able to do things that are sensible, then they need to be able to have some kind of certainty or some kind of ability to predict price into the future. And again, like with something like that, are you coming closer to a currency-like instrument? And then if you're a currency-like instrument, then where does that fall into the existing regulatory framework? Like, for example, money transmitter licenses. Do money transmitter licenses start to apply to something that is so like money it is indistinguishable? So there are lots of questions that, are interesting sort of debate at the moment. But I always come back to something that I think is more fundamental, which is you kind of just try and look at and a lot of people will say, the law is an ass, it's an idiot, and like it's very, you can always get an unjust result from the law. But the law is always trying to provide justice where it sees that there has been injustice. So what we always try and do is go like, can someone be misled in this? Can there be a point at which you can be said to be lying or defrauding or misrepresenting? And like, how do you make sure that there is enough transparency and education around everything to ensure that anyone who's coming into the platform is doing so with a full understanding of all of the mechanics of it, and you're not trying to hide anything? Because actually, what's most exciting about this space is the discourse. It's the ability to talk to people and put out an idea and say, hey, we're thinking about doing it like this. What do you guys think? Rather than going, here it is, it's perfect, and you use it or, go away. I think the regulatory framework is interesting. I think that a lot of the time it will just come down to whether or not, if you have defrauded someone, the judge will come along and find a way to make the law apply to you. If you have been dishonest in how you present something, that will happen. And so we just try and make sure that everything is an open conversation as much as possible.
Mm-hmm. Yeah, no, it's an interesting position to be in because decentralized exchanges have become quite emergent as of recent. People are starting to realize that there is potential behind it. It can actually work. And I think what you were pointing towards earlier, with concerns, even outside of being a security, if you were to do an ICO that could be defined as a security, you still have to deal with KYC in some sense, AML. And that is a fear for regulators being able to do things in a sense almost anonymously, especially if you had something that was private. And I want to go a little bit bounce around here towards Vic and everything, and ask you for your platform and everything. What's it been kind of standing out of the ICO space, standing out of really building cryptocurrencies? You've been building kind of an issuance platform. Could you maybe spend a little bit of time talking about it? What's it been like working with regulators?
Sure. We're a London-based fintech company. We're actually regulated, so we have what's called MiFID and CAS permissions. What that means is we can create and issue securities, and we can actually custody money and assets. So we're a regulated custodian. And we've been working on this for about 2.5 years now. When we started the company, our main focus was automating a bunch of different things that investment banks do, because traditionally investment banks perform a few different functions. It's quite obscure, adds a lot of cost, adds a lot of complexity. We wanted to automate and streamline all of this stuff. This is why we got regulated. This is why we've been building our own technology. And we can plug into the existing infrastructure to create securities and to transact securities and money. We can also plug into a blockchain, and this is where it comes to the regulatory piece. So in the UK, about 2.5 years ago, we got into something called FCA Sandbox 1. So the regulator created a regulatory sandbox in the UK, which was their way of putting more resources into understanding technology and new business models with the aim of making financial services more safer and transparent in the UK. So we were one of the companies that got into the first sandbox, and we got in because, firstly, the FCA thought there's promise here in automating a bunch of different stuff that banks are doing. And also, on the other hand, the FCA liked the idea of us testing execution on a blockchain. And actually, we got the permission from the FCA to execute on a public decentralized Bitcoin blockchain, which was what we did. So actually, the world's first regulated security token was a decentralized one on a Bitcoin blockchain. So we don't talk much about our work. There's hardly any marketing material out there about us. We're just very execution focused. We then got into FCA Sandbox 2 in the UK, so we're the only company in Sandbox 1 and Sandbox 2. And in Sandbox 2, we did the same thing. So we found an issuer who issued a simple bond. It was also tokenized on a public Ethereum blockchain. Is someone trying to silence me?
Is it working?
Hello? Okay.
You're back.
So we issued a bond that was tokenized on a public Ethereum blockchain. So what?
Keep going.
Hello? Hello? Okay.
Oh, I might have to move a little closer.
Right. Oh, sorry. Maybe it's my fault. All right. So we issued a bond that was tokenized, issued on a public Ethereum blockchain. We actually had money in our client money account as a regulated custodian of money and cash. And we showed how you can tokenize cash on the blockchain. And then we also did another, this same issuing company, they issued two bonds. One was a GBP bond, one was a cryptocurrency denominated bond. It's actually the world's first legally compliant, regulated cryptocurrency denominated bond, and that was done on the public Ethereum blockchain, denominated in Ether. We had new legal documents created, so this was fully compliant under English law and regulations. And that was Sandbox 2. So then again, we had a client who got into FCA Sandbox 3, so we found ourselves in FCA Sandbox 3 as well. We did the same thing in FCA. I can shout.
Yeah.
So yeah, then we got into FCA Sandbox 3, and in Sandbox 3 we actually issued securities through the traditional clearing and settlement systems. Hello. So then we issued securities that were issued through the traditional ICSDs. We also issued derivatives on the blockchain, public Ethereum blockchain. So yeah, sorry, I gave a long story just to set the scene. Now we're working with 2030, so we're in FCA Sandbox 4 supporting 2030. We're actually working with the London Stock Exchange as well, and this will be the first time in history that a regulated equity security token will be issued and transacted through a regulated exchange, and there will be a secondary market for that, and that will be through Nivora 2030 and the London Stock Exchange. And that's where we sit right now. And all of this activity, bearing in mind, this is without any changes in law and regulation in the UK. This is with the full approval of the FCA and with sign-off by law firms, by tier 1 capital markets law firms.
Good stuff. Really, that's impressive. You know, I mean, it's interesting to kind of get a point of view here because we have people from different fields, but along with that as well, different focus points. And obviously, the host of the event is Pillar. So I'd really love to hear from Michael, you know, just hear about your experience, because I've known about Pillar for quite some time as a project. I was very anticipated about the idea, the sense of controlling your own data, having everything in one place. You know, I'm curious what your experience has been on this topic of regulation for your project. You guys conducted an ICO, quite successful one. It's been a successful project overall, so it's good to see as well. And it's good to see the team and everyone working. So how's it been for the past year?
It's been a year to the day today since we've finished our ICO. So last year, this time, we would have been working hard with panicking. So since then, it has been a lot of experiments, trials, tribulations. Dealing with the banking world wasn't the easiest, and as quite a lot of ICO projects would say to you, converting your cryptocurrency into fiat isn't the easiest thing to do. So when you have employees in the company, you can't just pay them in cryptocurrencies and say to them, okay, go to Tesco, so the next shopping mall, and buy your groceries using cryptocurrencies. Even if you do that, then you've got an issue with the in our case, HMRC, or whichever the tax office is. How did you pay them? Are we going to use the spot price for the day you pay the salary? What if it jumps up by 10% tomorrow? It's a volatile market in terms of the crypto. So we had to weigh up with all those sorts of things when we were dealing with the banking situations. So as some of my colleagues spoke earlier on, we had to develop an extensive network in terms of being able to utilize the cryptocurrencies we've had. And also, we've quickly realized the regulator is not the enemy. We have to work with them. At every opportunity, we have to deal with the regulators, educate them about the cryptocurrency space, the blockchain space. And that's exactly what we've done. At every opportunity, we have spoken, I think David, Rob, Tomer have gone and spoken to HMRC, and they have done presentations, HMRC being UK tax office. So in dealing with the regulators, we had to extensively engage with them. And also, we had to see where the tokenization is going. Is it all going to be utility ICOs, or would it go into securitized ICOs? And as Vic alluded to earlier on, our sister company, 2030, is in the FCA sandbox, and it would be using the Pillar wallet as the ICO wallet in terms of delivering the solution. So yes, it has been a roller coaster of a ride, and we're happy to be here after 1 year.
That's awesome. And I want to go ahead and ask, the thing that I think most people tend to go towards, well, not so much ask, I want to bring up a point here I think you're absolutely right on, is that you should work towards cooperating with regulators, because as someone myself who has a pretty critical view of finance and government sometimes, it's very wrong to see things in a black and white picture where it's, oh, financial regulators are against any innovation in the space. We can see that regulators across from the SEC to a variety of different international organizations, they're tended to be want to be supportive of this industry. But again, they have clients and retail investors to take care of as an organization. And I think that's an awesome statement to make in regards to trying to work with regulators. And going towards this as well, I got to ask all of you, and we'll kind of, I think, just kind of go down the line here. I'm kind of mixed on this. I'm curious to hear what you all think. What type of token do you think is going to become much more mainstream? Do you see security tokens, and there's a big debate between utility and security tokens, becoming the next mainstream thing? What do you all see generally over the next, say, year? What do you think is going to be more popular?
I mean, I'll come back to what I said. I think that the key thing is going to be being able to look at the function of a token. Yeah. And therefore, that's the first question you ask. And I think that the function that we see the tokens, Vic's been talking about working on with 2030, as being those that have the same function as conventional financial instruments, and therefore will be treated like that. And I think that the more the techniques are realized for issuing those types of tokens, then I think the more you will start to look to see what one might say is a security token. But again, I don't think I want us to get too caught up on the naming. It's really what the demand's going to be and what the function of those things are.
So would you say, generally speaking, that it's going to become much more tailored individually to each and every case, kind of more, rather than getting stuck at labels, it's more defining every single...
I would hope so. I mean, I think there's an important point to pick up on the Vic made, was that all of the work, certainly that Nevura has done, has been within an existing regulatory and legal framework. I mean, I think we're blessed. In the UK, we have quite a flexible legal system, so you can deploy quite traditional legal concepts, and the regulators are quite open to that. And I think that's important, that as long as you have that degree of flexibility, I think there will be a way of catching it. But in terms of where it's going, I think these guys will be better qualified to answer that.
Awesome. What do you think, Vic?
Well, I'm going to be a little bit biased. So we're very investment banking focused, right? We deal with the banking infrastructure. We understand how assets are created in the existing system, how they're transacted, how all these different ledgers actually work. I think that there is a very, very viable use case for a public or a private decentralized blockchain allowing very cost-effective and tradable tokenized instruments globally. And I think for me, this is one of the most viable use cases of a blockchain for security tokens. I think this will also allow us to clearly or more clearly differentiate between what is utility and what is security. But make no mistakes about it, using a blockchain instead of certain other existing technology in investment banking will make things a lot more transparent and safer and cost effective.
So I feel like the future is less delineated in a way. We're doing the same thing as we did with money and Bitcoin, as we're doing now with securities and tokenization. Like, this is just the first phase. Like, what you actually have is a system of constraints where you can put a set of rules in that actually mean that you can create some really interesting instruments that just weren't possible before, or weren't possible in a easy to administer way. So, I mean, COCOs, for example, right? Bonds that turn from a debt instrument into an equity instrument in the condition that the company is failing, right? So you wipe out the shareholders, and then the debt holders get turned into equity, and then you can recapitalize the company. Things like that, rule-based systems that you can put into financial instruments, I think, are really interesting. We don't know where that's going to go. So I think that's a really interesting way that things might go. And then on the other side, you have, I think, non-fungibles. I talk about non-fungibles all the time. I think they're going to be huge. But then you have people making debt instruments off the back of CryptoKitties. So Dharma made the catalyzed protocol where they would take a CryptoKitty and they would allow you to use that as a collateralization instrument against a debt that you could then borrow against it, right? So you have this non-fungible, which is on one side, which is going to be huge for gaming and for collectibles and all this kind of stuff. That is definitely going to be a huge industry that then starts to bleed into the other side as well. So I feel like there's a lot of blending that's going to happen.
Can I just pick on a point? It's an excellent point. You mentioned a COCO, and I don't want to digress too much, but these are instruments that currently are seen as being very complex and just not fit for public distribution. And it just occurred to me now that here you have an instance of actually a new technology being used to take an existing economic concept, but to give more certainty to it and probably be easier to disclose, and actually therefore make it more available to a wider pool of investors. And that's exciting.
Yeah.
And I think there you're actually favoring the easier transparency.
Yeah.
Sorry for the intervention.
No, that's fine. I mean, we're
me.
going to keep thinking about things like this. Like, for example, on Radix, you can do messaging to wallets. So you can also do something where if you issue security, an equity instrument to your shareholders, you can now message all of your shareholders. So it trades, and then it stops trading, and now you can message to the people who are holding it. So you can send disclosures and things like that. You've got an easy way of sending disclosures, even though that has traded lots of times. If you have something like bond, like the cost of administering the dividend payout, the coupon payouts on bonds is huge, hidden cost in the banking system. You can get rid of a lot of that with DLT. So I think there's going to be a lot of really interesting innovation that happens.
I think on the point of making ongoing payments, there's a distinction between payments made by a custodian and payments made in the clearing and settlement systems. That's actually quite cheap and fast. So it costs less than €5 to do a transaction.
I mean, it's still expensive.
It's cheaper than sometimes on the chain. So like on Ethereum, sometimes more expensive. So the cost comes from the chain of custody around it, because when you issue a security in Europe, whether it's a bond or an equity, in most cases, you have to have a physical note which goes into something called a common depository. Then you have a dematerialized note that goes through an ICSD, International Central Securities Depository. It's this splitting of this instrument into a piece which is a legal piece and a piece which is a beneficial piece that adds a lot of cost onto the custody aspect as well. So there is the part about transactions, there's also the part about actually holding onto an asset. It changes when it's a blockchain type instrument. There is still a custody aspect, but the cost is a lot different.
Michael?
I would say, mostly agree with these guys. It is horses for courses and that. Just typical example, if I'm starting up a barber shop and I say to people, I'm doing a utility token for my barber shop. So you come to my barber shop and you pay a token. It is a little bit far-fetched because I can easily pay a tenner. It's not like I need it, but I can pay a tenner or $5 or whatever it is. So that's a clear case of maybe the securitized way is the best way for me to fund it. If you look at Ethereum, there is a clear utility in Ethereum in that you've got a smart contract, you've got the gas price to do it, so you can prove utility by using the Ether token. So I would say if it is looking at fundraising for a startup, it depends on what that startup does. Does it have natural users contributing to it? Say, in our case, in Pillar's case, we had close to 9,000 people contributing. And their contribution was, median contribution was around 3 Ether. In those days, it was around $500. Are they the natural users compared to 300 users putting in X amount of million each? There's clearly speculators. I mean, that touches the legality side as well, whether the Howey test, etc., would be applied to it. So I would say it really depends on what exactly you're trying to do, whether you're using a security side, a utility side, and the other ones, the unfungible, etc. I'm not sure whether they're trying to do fundraising for startups, but there are other means of representation on the blockchain. So.
So one thing I want to ask you all as well, because this is something I've been hearing about, and it was interesting, you had mentioned earlier in your speech about an initial coin offering being an initial token offering rather than ICO, which I thought was interesting. And it made me think, there's been some talks as well about alternative models to ICOs. Many people think that an ICO is kind of, it's going to be passing the times quite soon, that there's going to be some different type of model. Have you all heard of any different alternative models in the space that kind of have you excited on how these token offerings can be done? And for example, and like you were mentioning, the fundamental concepts of these tokens, understanding different fundamental approaches that people are trying.
I'm not, I mean, but I think the point that I would make is that where what you are looking to offer is genuinely an investment or a security, call it what you will. Currently, that's going to have more the characteristics of a normal securities offering, and that really just comes into what you're telling your investors and some of the mechanics around that. And I think that is an important point. I suppose the next form of evolution is where someone says, well, actually, if we are now issuing securities, and I use the term very, very, very broadly, using a blockchain-based technology, as certainly as Noura have been doing, is it actually time to say we need a different way of doing disclosure? I think there are general questions about how the type and quality of information that investors are given. This is now veering off slightly. People are being given too much information. They're not even reading it. You get this ridiculous stage, almost the longer the document is, the less chance somebody's going to read it. And so I think that also becomes almost the next stage of evolution. You know, I've been saying this is not necessarily just in the ITO or ICO context, but you know, in the delivery of a lot of services, why are we still hung up on written language pieces of paper? You know, do we start using video more? What is the weight that video has?
People brought that up.
Et cetera, et cetera. Yeah. Now, some regulators will say, actually, we'd prefer videos because they're easier to do. So I think that's the other area to watch. Then we want to talk innovation in terms of how, you know, we're still, what people are doing is still what I suppose economically what people have done before. I think there are new potential new applications. But part of the innovation becomes how we do those. Do we do them more efficiently and things like disclosure? That's where I concern to what I'm saying. That might have more.
Real quick to build on your point there, that's very true. There is actually in the Cambridge Analytica talk when they had Mark Zuckerberg testify in front of Congress, there was an older congressman who said, your user term sucks. And he was referring to the fact that when you agree to create a Facebook account, just like practically everything, you have to agree to terms of use. And I think the same thing could be said for white papers in these projects in the cryptocurrency space that are raising millions of dollars, and they don't have a way to simplify things. And I think this is why the SEC and regulators are very concerned when people are putting money towards this thing. When they hear large terminology, we tend to think that there's innovation there without realizing that in many cases it's too complex to where we can't even get a real grasp on what these projects are offering.
So what do I see that's exciting?
Oh, yeah. Sorry, going back to the original question. Yeah.
To be honest, I think what 2030 is doing is very exciting. This is one of the reasons why we're working with them. They want to provide a solution that firstly issues legally compliant equity tokens onto a regulated exchange for the secondary market trading as well. And they also want to offer this solution to loads of different companies. I think this is the next step in the evolution of democratizing capital markets. It's right there. And they've been brave enough to take that leap. And for us, as a Midland back office tech company, that's very, very exciting to work with. We have a couple of other collaborators and clients who are looking to do things which are around issuing a security token and then also issuing a utility token. For example, that gives some kind of right to use some of the underlying that's been generated. And so I think these kinds of things they're not happening at the moment with traditional securities, but because we're using a blockchain now, you can issue a security token, you can also do a utility token. It's allowing additional functionality to creep into the existing market infrastructure. So that's, for me, very exciting. I think it has long-reaching impacts on the economy, actually not just in a developed country, but also in developing countries as well. And that's something which we've been looking at for a long time.
Yeah, I'm sort of excited by everything because it's all just like this experiment, and we're all like, everyone's just chucking out these ideas, and the amount of brain power that's going into it is insane. and the amount of, and the speed that it's moving at is insane. I really like the new governance, some of the new governance models that we're seeing. I mean, it's not really a way of fundamentally changing the token economics, but it's sort of like something like Decred, who's like has their governance model on chain and a way of voting how the protocol moves. That's really cool, and like gives like this problem that when you don't design governance into your system, then governance still becomes an emergent property, like it did with Bitcoin, and like to some extent it did with Ethereum too. Then, you know, these new ways of thinking about, well, we have all these stakeholders, how do we give them a voice? Really like the way that's moving, and what that sort of may mean for the long term, because sometimes we think about a cryptocurrency platform, something like what Radix is building, as a digital state. And like the digital state has stakeholders there, it has citizens, it has people who are building within the economy. And you kind of have to think about all of the different parties and how they interact, and how you make sure that you don't have capture by one small cohort of that. And so I think that's a lot of the interesting thinking that's going on in the space at the moment is around that.
Yeah, with blockchain protocols kind of reaching their what people would define as third generation, I'm very fascinated not only by the differences in consensus that we're seeing, but along with that governance, who has the stakeholding in the protocol, and also the treasury model, because when we're talking about funding in this regulatory environment, many people have been curious about what that's going to entail for people who are stakeholders, and being able to, again, participate in these ecosystems and fund the treasury that will allow future development after the ICO.
And actually, just sorry, Mark, but just to pin on that, because I think, and it's a point I glanced at the end of my speech, but I think one of the idea around governance of blockchains, particularly these become trading environments, I think is going to become vitally important. Certainly in some of the discussions that we have with regulators, this is a question that's always raised. The typical thing is, well, what happens if the blockchain fails? And then somebody says, well, it's too big to fail. And you say, never, ever say to a central bank or regulator something's too big to fail. But I think those ideas, the governance, and you know, both governance in terms of participants, but also the ongoing integrity of the blockchains. And I guess it's true that the more critical mass you get, the better it is. That's quite exciting and I think important as well. Yeah.
I think I'll go along with Vic. I'm very much excited with 2030's offering of a securitized ICOs powered by the Pillar wallet. The reason why I'm excited about it is, just as the example I've mentioned, my barbershop would have a group of, a pool of accredited investors to go to, not just one-on-one going to a VC or to a venture capital or to an angel, not on an individual basis, but you would have a repeatable process, a platform. On the other side, for the first time in humanity, we will be able to sell and buy shares of startups in a secondary market. Normally, you sell shares once you've done an IPO, etc. So the accredited investor on the one side has got such an advantage. They can exit within a year. Yeah. They don't need to wait for an IPO or a merger and acquisition. They can exit 10% of their shares, 2% of their shares, whatever they feel like. So to me, that is such an exciting development in terms of getting funds for projects, etc. So.
I think you're right on that. When I was doing my speech the other day and stuff, the interesting thing, it's kind of a win-win for both parties. You have faster entry to liquidity, like you said, for example, for people who are giving out equity in their company. And along with that as well, those who haven't been able to participate in the world of venture capital or angel investing because they don't have enough money or they aren't accredited investors, to be able to finally start getting pieces of all these systems is really exciting.
And I think that the pieces aspect, the fractionalization is also very exciting. You know, you talk about democratization of ownership, it's a big term coming out of my mind. But the idea that in the past, all four of us would have had to club together, put our money into a pot managed by someone who would then go out and say, buy the Apple or the Berkshire Hathaway shares. The idea that you can now actually divide those up so we can each own those separately and have that sense of ownership, yet without having to stump up a bunch. I think that's also very exciting.
I picture it kind of like the opportunity where everyone in the world could own the next kind of unicorn company, could own Facebook, could own Apple in its early stage, and not later on when it's a well-established company, public on the market. You know, getting in early on projects that people are able to research, and it encourages, I think, people to learn about financial markets and learn about where to find value creation. So, I mean, man, this has been a really exciting talk, guys. I was curious to see if anyone in the audience, if you guys have any questions, we'd love to kind of open it up if you have any for anyone specific. Over there. Oh, sorry.
guys talk about regulators, talk in general terms. What's your opinion on the SEC? Because to me, it seems like different than everyone else, and I see it as a dishonest broker. How do you feel about dealing with some regulators if you don't feel that they're dealing in good faith? Sorry. You guys, everyone, you've been speaking about regulation, regulators in general terms, but like the big elephant in the room is the SEC, right? So how do you feel about, do you feel they're an honest broker, or they are like how do you feel about engaging with them?
This is being live streamed, so I love the SEC.
I love them
You
more.
guys are
I love
great.
them more.
Yeah.
I think if I take this on, I see them as an honest broker for what they're doing. The reason is they're dealing with, in terms of the highway test, a ruling from 1946, where some company, some hotel had some citrus fruits, and deciding whether selling plots of land to plots on them is a security or not. So adapting that to the modern world, we can safely say all the regulators were caught unawares. So they're bringing that and actually fleshing that out and trying to superimpose the nuances of the existing one. So they're doing a catch-up, and sooner or later they will be going towards clarifying it. So I don't see dishonesty in that. It's just they're playing a catch-up.
There's also the fact that this industry starts to represent real value in economies, right? This is $200 billion, $250 billion in market cap now. If we're right in what we think here in this room and generally in the crypto industry, it's going to continue to grow at a very large rate. And at some point, the SEC and the judiciary have to accept that this is going to be part of the economy, because it actually benefits them from a competitive point of view in terms of bringing jobs to America and in terms of bringing competitiveness to the American market. Now, that maybe there'll be some bodies along the way, right? But I think that long term, this has to be accepted as being a enabling technology for further economic growth, and that will be something that will push forwards it into mainstream adoption.
I think I'd make one general point, and that's about the allocation of power. I mentioned SEC and judiciary, but when we get asked similar questions in Europe, we just point to laws. And people say, how do you classify these things? It was all covered up in my talk, but actually you can point and say, we think it belongs here, here, and here. And so I think really it's looking to the lawmakers as well, and this is part of the whole point about being able to inform them and say, make laws that then the SEC can work with and the judiciary can work in a more constructive way. Go to the lawmakers.
But saying that, you don't just say the lawmakers would do it. Us in the crypto community have to go and engage with them.
That's it.
We have to work with them. We have to educate them. It's not just charlatans in the ecosystem. There are real businesses. Just look at us. That's what we have to try and do.
So I think just to cap off, shut down again. Okay, so just to cap that part off, every regulator has a big responsibility to do their best to make sure the market runs fairly and safely, right? Each regulator has slightly different mandates. They're sometimes funded slightly differently. For example, the FCA, many people think the FCA is a government body. The FCA is not a government body. It's an industry body. It's funded by the banks, okay? Different regulators are funded and run slightly differently. America is a huge market. There are things that smaller countries can do with their smaller populations and their smaller capital markets that a country like America can't do, because if a small thing goes wrong in a massive market, that's a massive problem. So I think we have to be a bit sympathetic and completely agree that it's a two-way street, right? We need to learn about the regulation and the law. Why is it put there in the first place? What was the purpose and the principle behind it? What came before? What precedences came before? We also have to then educate the existing industry, including regulators and banks and clearing systems and whatever, about new and different types of technology that can and can't be used. Blockchain is one type of tech that we're looking to use to do a specific thing. It just so happens that it also brings other things into it, the governance, the economics. This is a very complicated problem. You're finding cryptographers and technologists who are now getting involved in economics. You're now finding lawyers who are understanding how technology works. I mean, this is a massive education for everybody, which is more than just 2 or 3 subjects. There's lots of different stuff happening. So I think on the one hand, yeah, regulators are quite reactive in some respects, but it's also, you have to judge it based on the size of the country, the population, the capital markets. And just the final two things, so in Europe, France are doing very interesting things. The regulator brought in a new law regulation that gives more comfort for using a blockchain in financial services. And there's also now a push for legislational change in France, actually at the law level. And Spain, you're going to hear some very interesting news about regulation in Spain on blockchain over the next few weeks.
This gentleman over there.
I have a couple questions. One is for Andrew.
Oh dear.
And the other one is for Vic, and it's pretty tight. So for Andrew, I think the big change happens when these securitized tokens go from trading between accredited investors and opening up that to retail, and that's a big jump. And in terms of disclosures, Europe's, you know, if you look at the AIM index or the AIM exchange, it's not that hard to list small companies. So how do you see, you know, I see the value in low cost, right, from settlements, et cetera. But how do you see this? Do you see this one moving towards retail at some point, and what is your time horizon?
Yeah. I mean, I think Vic, you may be a better place to say it, but I want to make quite an important comment just about, I spoke in very general terms about how we classify, because the classification will determine the rules and disclosure that apply. There is still a question mark, in my mind at least, as to exactly how you classify an equity token. We've got a view, I think, on how it should be classified, but the particular classification probably wasn't originally intended for that thing. We say the law is flexible enough to allow for that. And that's good when we're doing a private placement and accredited investors. The thing that still continues to worry me is that if we now want to open it up, and I have to now take my approved prospectus, because that's what I'll require, and go along to the listing, the UK listing authority, say in the UK or whatever, and say, we've classified it as, say, a share. They'll say, well, hang on, but it isn't a share because that's not, it's related to a share. Or we've classified something else. What are the exact rules and disclosure? And you know, I said earlier, we need to look at how we need to change the laws. But I think that could be a potential sticking point. I think it could be negotiated. But the better way, you know, it does better than having to negotiate with the regulators, actually saying, let's get you to change your rules, or better still get the lawmakers, the parliaments, to change the rules to accommodate for that. So that I still see as a potential stumbling block from kind of legal, what are the rules that apply and what standards do we have to then apply. But I think in terms of the mechanics, maybe you can...
Do you want to ask me your question? I'll do both.
So, I mean, I guess it continues to what you were saying. If you're an accredited investor, a VC or a PE firm, you can already invest in the secondary markets, and I mean, those guys don't need to go through an exchange to do that. And especially if you're listing small, like micro companies, it's going to be very illiquid, and the information is not going to be as comprehensive. So, I mean, the biggest risk is the market fails in terms of liquidity, and there's not much trading of those things. And you know, whatever you're doing, it makes sense if retail investors get involved, but that's a legal issue. So how does, and for that to take off, you have to start with the accredited investors, and you know, the VC industry has gone through this iteration a few times, so it hasn't worked. So what gives you confidence this will work this time?
That's actually a very good question. So let's pick it up. So you mentioned London Stock Exchange AIM market. AIM market is for mid-sized companies to list their equity. LSE also has ORB, order book for retail bonds. It's also a mid-market for listing bonds. Then you also talked about how VCs have access to buy and sell. Let's say in closed markets or in private markets, they can buy and sell shares in smaller companies as well. Totally right. However, it's not easy to list on AIM. It's actually very difficult. It's not easy to list on ORB. It's actually very difficult. They haven't been that successful, right? The work we're doing with 2030 now, Pillar in 2030 in Sandbox 4 with the London Stock Exchange, it's specifically using their Turquoise network. Turquoise is a network where they've got loads of high net worth and funds and family offices who can actually invest directly in instruments which are not publicly traded, but they can be publicly traded. There's already a market there. There's already liquidity there. The blockchain doesn't solve all these other problems of due diligence yet. There are other things that my colleague will go on to later on, but it doesn't solve all these other problems. There are other things we're solving in our solution with 2030, which will solve how a company can list in a more cost-effective, cheaper, and transparent way. The blockchain comes into the part of how do you transact, how do you create this asset, give it to somebody, collect the money, and do that without having this complicated investment banking infrastructure in the middle, which adds loads of cost and loads of obscurity. That's what we're solving with the blockchain on this particular thing. So yes, there are existing problems which are not solved by a chain, they're solved by automation of other stuff and understanding why that stuff is there in the first place. Then there are other problems and other costs which are solved by using a chain in a proper way though. So it's a bit of both. What makes me confident working with 2030 about the project that we're doing, we're solving all of these things. That's why I'm confident. And we have the LSE assisting in this because they know that with AIM and ORB, LSE's responsibility is to help companies to list, right? It's a very costly process for a company to list, even if they're not listing fully an IPO, even if they're listing a smaller equity or something. It's still a very complicated process. There's a lot of other things that have to fit in place for this to happen.
Just to add some stats for you, last year there were 23 companies that raised funding in an IPO in AIM, and that was 2.1 billion. Compare it to this year's, half a year's ICOs, which is about 8.1 billion with 334 companies. So AIM is not what it's cracked up to be, really.
We'll take one more question here.
Okay. Excellent panel discussion. I was just wondering, you guys are saying that there are going to be bodies along the way and that we have some very good regulators that are helping us. I'm just wondering if, like, there's a projection that ICOs go, a lot of them go belly up. Is that going to allow the regulators to come in and be a little more heavy-handed, or do you believe that they're going to continue to allow decentralization?
I'll leave it to you guys to give the interesting. I've got a rather dull response to that. I'll tell you that afterwards.
I mean, if you start off from the recent speech the corporate finance director of the SEC made, I think it's around February, he didn't really completely rule it out. Ultimately, he ended up saying every project that does an ICO, they have to engage with us using their counsel. And he laid out specific criteria. He was adamant that the Howey test is in operation and it works. But they didn't completely rule it out, so they're still, as far as I understand, deliberating it. That's my understanding of it.
I feel like that there is like everything goes through phases, right? We're going through a liberal phase. I think that a big enough project goes belly up, one that's raised a few $100 million up to the billions, not mentioning any names. If that one turns out to have been massively fraudulent, yes, there is going to be a reckoning. The thing about that is that it will create the law. It will add clarity. That is really important because what that then gives you is the jurisprudence for you to be able to say, this is how the law applies. And now we have clarity over that. And so while it's not going to be comfortable for the industry or nice to watch from anyone, and like the litigation for this isn't going to spread out for a few years, it may be a couple of decades. Like it's going to be international, it's going to be messy, it involves a lot of money, a lot of people, a lot of disclosures through channels that were never really used before, like private telegram channels and things like that. It's going to be really difficult. But once that has been finished, there will be much more clarity in terms of how we can operate in that, and that should then mean that there's less friction in operating within the law as well.
Can I just cap? The FCA released a paper in December 2017, and in the paper it was a discussion paper about using blockchain/DLT. And in that paper, because of the work we've done in the UK, the FCA made a statement there saying they don't see a public, permissionless, decentralized blockchain being incompatible with the law and regulation in the UK. Right? This is crucial. I don't think many people have actually read that paper yet. Just go and Google it, find this FCA sandbox paper that they've written at the end of last year. This is very important. It doesn't mean that the regulator is not saying, yeah, go and use the decentralized infrastructure. They're also saying don't be afraid of using it. If you can show us that you can manage legal liability and safety in this system where you're using a technology which is meant to help make things a bit more transparent for them because they can see things happening, then go and use it. I think the question is really how do you manage the information that goes in and out of this chain and what you're looking at on that chain. These are really important key pieces here. This is why, for example, R3's Corda is becoming more popular amongst banks because it's providing this kind of, here's a private permission system, maybe this is safer, maybe putting information onto this is safer, maybe it's not. I think we have to understand what is the mentality behind them, what are their thought processes first, and then say, okay, you can actually have a similar safety by using a decentralized infrastructure.
I will finish despite what I said. I mean, I think the key thing is it comes back to the question of wrongdoing or fraud. Actually, what goes wrong is what gone wrong when they've developed blue skies laws. And I think you've got to look to that. If everybody's behaving properly and the law is compatible, and I think Vic makes a very important point, there's not a problem. When there is a massive fraud, and then there possibly a political momentum believes to say actually the fraud was made easier by the means in which information was delivered, then there's a problem. But I think you've got to look for that essential wrongdoing, and that will probably fashion the response.
Yeah. I think generally regulators are only going to be disturbed when they ask the question of why did so many of them fail, and they find that there is conflict in previous set laws. I mean, a lot of ICOs do sell dreams at this point that are way too far out there to achieve. Some of them are raising very high targets, and I think more than anything, they would want a case like that. Again, no naming names, but yeah, selling a pipe dream and raising not just tens of millions of dollars, but hundreds of millions to billions. And that's the poster child that they'll be able to make arguments for sound regulation, and hopefully it won't go too far. But again, we've seen that the greed in this space can sometimes be overbearing in that case. So anyways, I mean, that was a good amount of questions. We had some good topics to discuss. Thank you guys for coming on the panel. Appreciate it.
Thanks.